name is Rob. I organize Idea to IPO. We've been holding events in Silicon Valley for many, many years. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 350,000 members among all our meetup groups all around the world. We've organized, promoted, and produced over 3,500 events. By any standard, by any measure, we're the most active, most prolific startup event organization in the history of Silicon Valley, bar none. Well, back in the day, I used to get a standing ovation, but we're not quite back yet, but we're coming back. We hold venture capital panels, legal workshops, networking events, and more. We have an event nearly every day of the week. Check out our schedule at ideatoipo.com. Our mission is to promote entrepreneurship, support entrepreneurs, build community, and provide value in the Silicon Valley startup ecosystem. To that end, we provide content that's practical, actionable, and relevant, stuff you can actually use to succeed as entrepreneurs. And we believe in building community because Silicon Valley is a global aspirational ecosystem. It attracts people from all over the world to come here to do great things. Who here is not originally from Silicon Valley or the greater San Francisco Bay Area? Raise your hand. Raise your hand. Anyway, who here was born and raised in Silicon Valley or the greater San Francisco Bay Area? Wow, like 5 of you. Well, welcome to you natives. So whether you were born and raised here or just arrived last night, it's important for us to provide multiple channels for you to meet people, build relationships, and grow your network. With regard to value, it's important that we provide value at each and every one of our events, so we make sure our events are affordable. And if you cannot afford the cover charge for whatever reason, come talk to me, and we can work something out. And at each and every one of our events, we want to make sure we provide a delicious buffet meal. Is that a delicious buffet meal? Oh, at least half of you think it is. That's okay. So I want to thank Procopio for sponsoring the delicious buffet meal. So let's hear it for Procopio. Credit for where credit's due. I usually sponsor the watermelon, so anyway, FYI. More importantly, though, at each and every one of our events, we want to make sure that we provide value for your time, which is your most valuable asset. Anyone here getting any younger? Besides our moderator and our panel and this young man. So when you invest your valuable time to come to our events, we want to make sure you maximize your ROI. We have many partners that help us do what we do. Law firms, venture capital firms, angel investor groups, incubators, accelerators, colleges, universities. Tonight, we're grateful to Procopio, once again, for hosting us at this beautiful venue. Let's hear it for Procopio again. Roger, you want to say a few words about Procopio?
Well, first of all, thank you, everybody, for coming tonight. It really is so great to see people in person again after the pandemic. We've started having a couple of events, and there's just nothing like being in person. So about Procopio, in case you hadn't seen, we're a full-service law firm, 280 lawyers. I head up our emerging growth and venture capital practice group. We have 27 other practice groups, so IP, litigation, which hopefully none of you need, and all of the other practice groups that are important to startups. Startups are my passion. I was an entrepreneur for 10 years before I became a lawyer. So I enjoy working with startups from inception all the way through the IPO. Thanks again for coming.
Okay, some of our other partners are here tonight. I would like to also have them come up and say a few words. Let's hear it for Ken and Cordify. Applause.
Hi. I'm Ken. I'm from Cordify. We're a software services company. We work, our tagline is, we help startups grow. So we help startups grow through software development services as well as staff augmentation services from India as well as from US. And so we know that you guys, entrepreneurs, are always busy doing stuff with pitching to VCs, pitching to clients and customers. We are at the back end of your services. We help you develop your products while you are busy with your VCs and your customers. And we have a solid engineering team. In the last 10 years, we have actually probably co-launched or launched about 30 products. We have senior solutions architects, developers, data engineers, and the works. And we work on full stack development, we work on .NET, we work on IoT services, on everything, anything that you can think of. We have a team of about 50 engineers in India. We are starting to develop a team in Mexico. And so if any one of you need any help in your startup development services, software development services, please come talk to me. I have a table right there with my partner, Supriyo. Right. Thank you.
All right, next up we have James from Metis. Applause.
Thank you, Rob. My name is James Pham from Metis Real Estate. I work with home buyers and sellers in the Bay Area. And if you need any help with buying real estate, please contact us. Me and Connie will be in the back to help you out and answer any questions.
Okay, next up we have Alina from Nucleate. Applause.
Hello, everyone. My name is Alina, and I'm a managing director at Nucleate. Nucleate is a worldwide accelerator. We're non-profit and we're equity-free. We have 18 chapters in the United States and about 10 abroad. We help students from top schools all over the world to start a biotech company. Please come talk to me and my colleagues, Alena and Eric. Thank you.
Okay, last but not least, we have Anita from Happiness Factors. Applause.
Thank you, Rob. I would first of all like to thank Rob, Idea to IPO, and Procopio for helping us all by hosting this event. And I have been coming to this event ever since I started my startup 5 years ago. So I'm Anita from Happiness Factors, and we are the bridge between AI, mental wellness, and holistic best of East and West. We offer total solutions for busy professionals and sell our products B2B. Currently, we have 2 clients, and we are giving great discount to 8 more early adopters before we go full price again. And we are looking for some more investment as well as clients. And if you're interested in learning more about holistic best of East and West and mental wellness, and not just get happy, but sustain it long term, come talk to me. I'm sitting right here. Thank you.
So, though our local mission is to support entrepreneurs here in Silicon Valley, our global mission is to democratize entrepreneurship and innovation all around the world. To that end, we maintain a robust YouTube channel, youtube.com/idea to IPO. Go check it out. We have tons of videos there, and this rich, valuable content is available on demand, anytime, anywhere, totally free of charge. And our partner in this endeavor is Tim Jeggers of Jeggers Films, one of the top professional videographers in Silicon Valley. So let's hear it for Tim. Applause.
Thank you, Rob. Thank you, everybody. So I'm Tim. I do all sorts of multimedia development. I specialize in video production, though. So if you have any questions about that or some of the stuff I've partnered up with Rob and all sorts of other people throughout the Bay Area, I'll be over there, and I'll be here after, obviously, too. And I'd be more than happy to chat, answer any questions you may have. And yeah, it's great to be back here in person. I think Roger put that very well. And I'll give it back to Rob. Thank you.
So here's the schedule for the rest of the evening. Our panel will hold a brilliant, compelling, dynamic, entertaining, and scintillating discussion, right? No pressure. We have high standards at Idea to IPO. Yeah. At 8 o'clock, we'll open it to questions from the audience. We have a mic stand here. We'll take questions till 8:30 p.m. At that point, we'll end the program, stick around, network, socialize, and connect. You can talk to the panel one-on-one. We would like to leave the building by 9 p.m. as a courtesy to Procopio. There is an after party in the works. The 3 options are... Taco Bell. That's not on the list, unfortunately, but feel free to go there. We have the Rosewood. I know it's Tuesday night, not Thursday. We have the patio, and we have Pizza My Heart. So more on that later. It's still not concluded where the after party will go. We'll decide before the end of the night. So at this point, I'm going to hand it off to our distinguished moderator, Roger Rappoport of Procopio. So let's give it up for Roger and our awesome panel. Applause.
Great. Thank you, Rob. Just before I start, I forgot to mention, you'll see on your chair, there's a flyer for a workshop tomorrow night. It's a 4-hour workshop on developing a funding strategy. And since most of you here tonight are probably in the hunt for money, it could be very helpful for you. There are 5 seats left. It's upstairs at our office tomorrow night. So if you're interested, please RSVP. It's the second one. So thank you, panelists, for joining us tonight. We've got Jordan Wahbeh of Silicon Valley Venture Group, Ekta Dang, CEO and founder of YouFirst Capital. We've got Ashish Aggarwal, partner at Chamaeleion, and at the end, Matthias Weber, venture partner at Mighty Capital. What I'd like to do just really quickly is to go down the panel. We'll start with you, Ekta. If you could just briefly introduce yourself, tell us a little bit about your background as an entrepreneur, investor, technologist, and then we'll just sort of move down the line.
Thank you, Roger. And thank you, everybody. And thank you, Rob, for having me here as well. I'm the CEO of YouFirst Capital, which is a venture fund that invests in both. We invest both in enterprise and consumer companies, but largely enterprise tech. Prior to starting YouFirst Capital 4 years ago, both me and my co-founder, we were investing through Intel's venture arm, also in enterprise tech companies, largely in AI, big data, cybersecurity, and IoT. And we were in deep technical roles early on in our careers before we switched over to or transitioned to venture capital. And by way of education, I have a PhD in physics and learned software over the last 2 decades, and from entrepreneurs like you, actually. Thank
Jordan.
you.
Is that for me or for her? Good evening. Thank you all for being here. I'm Jordan, Silicon Valley Venture Group. I see a good friend of mine called Peter. I talked to him this morning. I'm with Silicon Valley Venture Group. We are a pre-Series A and a Series A investment group. We improve in companies that improve. We invest in companies that improve the human condition. B2B, B2B2C. We write checks $300,000 to $500,000. We're also part of a group called Network VC, a syndicate of chapters worldwide. We have 280 investors, and we invest in 3 to 4 companies per month. This is for you. We are here for you to help, to support, to engage with you in any way we can. So enjoy the show and make it a pleasant evening for all. Thank you.
Hi, everyone. My name is Ashish. I'm a partner at a fund called Chamaeleion. We're an early stage fund, primarily investing in seed and Series A investments, $1 to $5 million check size, sector agnostic, investing globally. We have offices in Portugal, as well as offices over here in San Francisco Bay Area. My background is a combination of, I was early in my career engineer and product manager for Yahoo, built out Yahoo's ad tech platform for many years between India, China, US. Had a couple of my own startups that didn't scale well, so came to the US almost a decade plus ago for my MBA. Worked in a couple of other corporate gigs, did marketing for a large company, ran corp dev for another company, did a bunch of buy-side, sell-side deals, and then moved into early-stage investing. Been investing in AI, ML, robotics for last 6 years. And then we started the fund a couple of years ago, Chamaeleion, which is the latest fund, early stage, fund 1, but we've been investing together for a while. And I'll talk about differentiation factors as part of the future questions.
Okay, good evening. My name is Matthias, and in order to be able to blend into this panel, I have a PhD in physics. That's really true, but from Switzerland. I'm working on it.
Is it like Sheldon Cooper or better?
So after getting my PhD degree, I had a career at Swiss Reinsurance Company. It's the world's second largest reinsurance company. And I was the chief underwriting officer of this company, which means whenever there was a hurricane somewhere, it was my fault. I got used to it after a while. I retired in 2017 in order to be able to move to the US. My wife, she grew up here in Silicon Valley, and I promised to her that after my retirement we would move. So we did move. And being here, I felt too young to not do anything, so I tried to blend in again, became board member or advisory board member for a number of companies, started doing some investments, and 3 years ago I became partner at Mighty Capital, which is a San Francisco-based investment firm. Our check sizes are between 1 and 5 million. We focus on enterprise B2B, enterprise SaaS, do also a little bit of fintech, including insurtech and health tech. So far, we have done 27 investments with 3 IPOs and 3 M&As, so on average 1 exit per year approximately.
Excellent. Ashish, I'm not sure we got the check size from you guys.
Yeah, we do similar to them, a $1 to $5 million check size as the first initial check.
Okay, and Matthias and Ashish, do you guys lead or do you?
We lead and co-lead majority of times. It's very rare that we will follow in.
Okay.
We tend to lead or co-lead mostly.
And Jordan, what's your typical check size?
We do two sizes, 300K or up to 500K.
And do you do follow-on as well?
We only follow.
Okay. How about you, Ekta?
Yeah, we invest between 3 to 5 million, and we can lead or follow.
Okay. So, the pendulum swings. Right now, the pendulum seems to have swung in favor of VCs. What do you folks... Yeah, I think we got to move. But it's cyclical. We've seen it in 2001, 2008, and now we're seeing another pendulum swing. This is open to the panel. What differentiates you from your competitors in the VC space?
So, well, now I'm blushing. The first comment, if I may, the pendulum swings, right? After I moved here, I also learned that one of the unwritten rules in Silicon Valley is don't take opportunistically advantage of the situation. Try to be fair to all the stakeholders. And I think that's really important, especially in such a situation. What makes Mighty Capital different from other companies, right? Every VC has partners and with networks and domain expertise, and so do we. That's, in my opinion, a necessity to play, but not a differentiator. What makes us really different from all other VCs, to the best of my knowledge, is our managing partner, SC Muati. She's also in charge of a network with the name Products That Count. And this network consists of more than 300,000 product managers, mid to senior level product managers. And we obviously do have unique access, which we can give to the entrepreneurs we invest in. And through this access, that allows the entrepreneurs to recruit from the network product people, to sell into the network, to get advice from the network, and eventually, when the time is right, we can initiate M&A discussions.
Great, thank you. Ekta, how about you first?
Yeah, we come from a corporate venture capital background, so we have a very deep corporate venture and innovation network And because of our technical backgrounds and our network in the tech world, we are able to tap shoulders very quickly and say, hey, we come across this company and we are trying to evaluate, do a fair due diligence on the company and see if that company will be able to find a product market fit in the markets it's exploring. And those answers come to us quickly through our trusted networks. And we are also able to bridge our portfolio companies to a variety of corporations because we have an unfair advantage of listening to their innovation needs, which we have been patiently doing for the last decade, if not more, actually. And that helps us evaluate and help our portfolio companies to see how quick they can reach a product market fit. And particularly in these markets, it becomes even more important to show that there is market on their side, which thinks that the technology that they are brewing is basically a painkiller and not a vitamin.
And do you also bring CVCs into the deal with you?
Yes, we do. We do bring in CVCs into our deals.
Jordan, what's your differentiator?
We're street fighters. We don't write big checks. We're fast. We write checks in 3 to 4 weeks. No BS, no dragging things out. You come in, you come out within 3 to 4 weeks. It's either a quick no or a very high potential. You present to our investors, and if they like you, you can get a check in 3 weeks or so. I left Bay Angels because I wanted to improve the human condition. I don't want to make money. So if you're into that, we are into it too. Alexander Sirocco, the founder of Network VC, wants to beat the big boys, so I'm in it to win it. But the fact is, everybody here has a very unique differentiator. So the best part of it is pick us all, or pick the best looking one. But at the end of the day, there's many choices. That's why I said best looking one. But at the end of the day, you've got multiple options, and each one of this very fine panel can offer you something. Remember, you start with seed, late, Series A, and beyond, and we cover the wide spectrum. And if you want particle physics, there's your guy.
Ashish, tell us about your differentiator.
I think just taking a step back, right? I mean, if you look at the last 2 decades of innovation in venture capital, it's been focused primarily on either brand building or value-added services once you have invested in a company, in a portfolio company. And you can kind of like think about companies that have done, or VC funds who have done that at scale. I think from our point of view, the reason we started this VC fund was because we believe the 100Xs are actually created when you pick the company to make an investment in, and then when to exit the company. I think VCs are not really good at when to exit the business, and I think there are multiple articles written that you can read through in the last couple of years when VCs try to be kind of like public market investors when they are not. I think for us, we took a very data-driven strategy. We have our own in-house tech and quant engine that we have built. We have in-house software engineers, ex-Goldman quant people, data engineers, which is very unique for a venture capital fund to have that type of team. So we are tracking millions of companies. We have built our own deal sourcing, diligencing, and benchmarking engines. And our idea is to look at 10 to 20 times more deal flow at top of the funnel, which is highly vetted, unbiased, and have characteristics of companies across multiple different sectors. And we have been using things like AI, ML for automatic categorization under different taxonomy. So we have built our own complex engines. So that can like differentiates us significantly in terms of deal flow from that perspective. In terms of networks, we have something called #KIN, which we call as a people augmentation layer that includes CXOs of large public companies or founders of startups that have been very successful who are parts of our network, who are either LPs in us, who are advisors to our portfolio companies, who are domain expert, who help us not only make investments, but also help our portfolio companies scale. And as part of that, the third thing that we have built is how we work with our LPs to add value to them in different capacities, going beyond just providing financial return. And I think from the bundle of all these things can differentiates us significantly. Of course, we do everything else that everybody else does in terms of inbound deal flow. So from building the brand, speaking at events, founders, networks, all of those things. All of us have built and scaled companies. All of us in the team have been operators turned entrepreneurs turned investors. So all of us have built and scaled companies in Europe, Asia, and US. So we also come with operational backgrounds, and that's where we can bring a lot of practicality of, we understand what it means. I mean, I'm 2-time failed entrepreneur myself in terms of starting companies, so I understand what it takes to build and scale something from grounds up.
Great, thank you. So just a question for the panel. Maybe we could talk about startups team. How do you go about evaluating a startup team, and what qualities do you look for in founders? Maybe you could start off us off.
Yeah, that's a really good question and an evergreen question actually. And it also, I think, depends a little bit on the stage of the company. In the early stages of the company, we really look for the strength of the team. And whether the entrepreneurs have the background, the experience to go after the market that they are going after. Do the CEOs or the leadership team understand that they have a certain talent and they need to get some complementary talent around them to be able to progress to the market efficiently? So A, what is the constitution of the team, the background and the experience, and B, how is the leadership team thinking of building building or enhancing on their leadership team to better approach the market that they're trying?
Are there any particular qualities of a CEO that you kind of look for, or when you see it, you go, wow, that's someone I could really back?
I think one is tenacity, of course, and whatever happens in the macro environment, whatever happens inside the, there are a lot of things that go wrong in building a startup, and it ranges from the macro environment all the way to the teams not gelling together with each other. But if the product market fit has been evaluated, and the team has a background to maneuver those storms on how to make the fit better, then really that becomes an important core ingredient for success for the entrepreneurs.
How about you, Matthias? How do you evaluate the team?
Okay, so when we look at the team, and we typically invest at around Series A, at the team overall, we look at the skill sets. Do they have deep domain expertise? Do they have complementary skill sets? Have they worked together before? That's a plus. When they interact with each other, are they respectful, using their soft skills? When we look specifically at the CEO, we would like to see a CEO who is a good listener, who is also a good communicator, who is good at attracting talent, and most importantly, who is good at building a culture.
Sounds like a good storyteller. How about you, Ashish? Anything different that you look for?
I think the two things that would come to mind is, one is understanding the coachability of the entrepreneur in terms of understanding, because expecting an entrepreneur to know everything is not feasible, right? So the question is, can an entrepreneur understand what they are good at and what they are not good at, and being able to identify people whom they can surround themselves with, who can fill that gap. Second thing that I think is very helpful to understand, how have they behaved in adversity? And I think that's where the reference checks comes into play, because it's very easy to see how when things are going well, everybody would behave well. But then when things go bad, that's when you see the true color of people. And that's when being able to understand how people behave at that time is the true judge of their character. And that's where the blind references come into play on that side. And I think one other thing I would say is the idea goes hand in hand with the team. For example, typically in enterprise startups, you would see people who have domain expertise, who understand and who have done the sales to understand what the problem is. Whereas in consumer startups, you would typically see a lot of first-time entrepreneurs because they are trying to come up with new ideas on that side. So understanding the type of idea that somebody is pursuing versus the background and being able to kind of like match that is very important.
You mentioned that you use AI and ML in assessing the startups that come to you. Are you using that AI and ML to assess the team as well?
Yes, yes, we do. And I think at the end of the day, I think you have to understand all of these are just inputs. At the end of the day, the humans, as in like, we are the ones who are making decisions, and having data combined with your own opinions. Of course, you're trying to reduce the opinions as much as possible and do a more fact-based comparison. That makes things easier. As I think has been said many times, like, please don't bring your opinions, please bring facts to the table when you're having a discussion. That makes it unbiased.
Jordan, how about you? Anything that you look for or that when you see you want to run?
How many founders or co-founders in the room? Hands up. So I've been in a couple of startups. Running a startup is a shit show. It's a horrible job. I don't envy you guys. It's the worst job in the world until you make it. So I look for character and strength of personality. It's like a war. One day you're attacking, the next day you're defending, one day you're holding, the second day you're recruiting. It's a constant change. So if you're not that strong of a person and you don't have the ethics to do the right thing for your company, that always surfaces to the top, back to adversity. Otherwise, you can stand in front of TechCrunch and have the best presentation, everybody claps. When you go home, you got to do real work. If we were looking for real people with fundamental strength of character and personality, I no longer look for our fundraiser king. God did not put you on earth to fundraise. He put you on earth to build a company. So your talent in selling the investor in your company is good. It doesn't make you a good CEO. So I'm looking for character and strength of personality.
Great insights from the panel. Take note when you're going out to pitch. One thing I get all the time when I'm working with clients and they're going out funding is what's my valuation? How do you folks look at, and particularly in this environment, valuing a company? What are the factors that you're taking into account, and how do you arrive at that pre-money valuation?
So we do a DCF, and then we throw it away because it's not that helpful.
Discounted cash flow, DCF.
At the Series A stage. We typically, in more earnest now, we typically use multiples as a function of the verticals, the space the companies are in, and we adjust them based on their individual gross margin, the growth trajectory they are on, the size of the TAM, etc. And when we look a little bit at later stage companies or companies who are close to an exit, we actually start with the exit and an exit multiple and work ourselves backwards.
How about you, Ashish?
I think valuation is kind of is a fact. I think you have to remember, like, if you take a step back and figure out, we are the buyers of we are offering a product, and then we are basically buying equity in a company, right? So you have to understand the factors that demand, right? And I think similar to any kind of like demand-supply equation, over here you have to understand what you're buying, what is the demand for that product. If it is in big demand, then you have to pay higher price for that. So I think from that perspective, like today, if you're trying to build a generative AI startup, and if you're in demand, you can name your price. And I'm seeing companies that have raised 100 million round, 100 million post-money valuation, 10 million with like the team with like nothing else but just a pitch deck. Whereas if you are doing something else, it's going to be very hard for you to raise capital in that. So I think it's a function of that, first of all. It defines at least the parameters in which what you can ask from a founder. And I think that then second thing that comes into play is what is the reality of the market in terms of what sort of company you're building, as well as historically, if you look at the last 1 year, I mean, and this surprises me, is as a founder, you can go back and look at what are the companies in your sector that have raised capital in the last 1 year in your stage, and what was the pre-money and post-money valuation for that, and what type of round size they were able to raise at different stages. And those two in itself would give you at least some sort of benchmark those are exactly the same thing that investors also use. And then beyond that, the final numbers are just a negotiation between the founder and the investor. But I think you have to understand the people whom you're taking money from, what sort of return profile they're looking at, right? For example, if you're talking to angels versus actual institutional funds sometimes they want to have ownership of anywhere from like 5% to 20%. And you have to kind of like understand what sort of exit they're looking for depending on their fund size. And if you just Google like some of these things, you would be able to find articles and read through that. And it'll give you a bit more understanding of when you go into negotiations with the investors, you are more educated in terms of understanding how to think about what are the other factors that I'm thinking about when I'm investing in a startup, and what is the opportunity cost for that dollar that I'm giving to you versus someone else.
Ekta, how do you look at it?
Yeah, I totally agree with, I think, both sides of the coin, if I may say. And Matthias, I totally agree. Sorry. Yes, thank you. Sorry. And so methodically, there's a process. We look at the multiples. We look at what segment the company is playing into, and how have the past successes behaved, and we can extrapolate based on that. But the reality is, we're closer to what Ashish said. If there's a startup which is writing on a clean slate, they're writing on a whiteboard, and we really don't have a comp, so to say, a comparison even close to what they're doing. And they have team members who we know, have, let's say if they have an investor or an advisor who's the ex-chairman of Cisco on the company, then you obviously have to evaluate that's another dimension added totally to the team. And you have to sense the ability of that particular company to scale based off of that. So who you have on the team, even if they are participating as an advisor or an investor, or in some capacity where they have the potential to change the growth trajectory of the company along with delivering velocity to that trajectory, all those factors have to be kept in mind to be competitive enough to give a fair market value of the valuation of the company, in my mind.
And Jordan, let's just switch gears a little bit here. What are some of the biggest mistakes? You've been in a startup and you're now funding startups. What are some of the biggest mistakes that you see entrepreneurs making in the fundraising process?
I think if the founder believes it's his or her mission to raise the money by themselves, that's a total waste of talent. I have switched from believing they have to do it to don't try to do it, get help. And listen, if you want to spend 60% of your time talking to investors for the next 8 months and not focus on your product and all the things that God put you on earth to do, that's a big mistake. Some VCs will vehemently disagree with me, but you're not here to raise money. You're here to build a company. So make fundraising a very mechanical, project-oriented, and get it done, and bring people in to help you. So that's the first one. 2, fire quickly. Don't get married to the co-founder. Don't get married to the top engineer. Don't get married to the CFO. If you don't like who you're working with, get rid of them, and quickly. Because the worst thing you want to do is let this thing fester. And then it becomes a cancer, and then you can never get rid of it. So I'm going to leave the rest of it to the rest of the team.
When you say get people to help, who are you thinking about in helping fundraise?
I started in 2015. It was a pure art. Now it's very scientific. There's tons of platforms, tons of experts, hundreds of people who can connect you to thousands of investors. Guys, don't spend 25 hours a week doing the stupid slides. Don't try to reach to every VC that has a sparkly light all by yourself. There's resources out there. If you don't have the money to fundraise, don't do it. Don't even start the business. But You're not here to fundraise. So the resources to fundraise are abundant. Tons of professionals to help you. Get their help, get it done, and go home and build the company.
I will just say, do not use people that are not licensed broker-dealers to raise money and get percentages of the raise. It's illegal, and it can really hurt your company. But definitely people that are qualified. Ashish or Matthias?
So I would like just to add one thing which I believe might be especially important in the time we specifically are in, which is probably characterized. Cash is king, and it's not totally easy to raise cash compared to 1.5 years ago or 2 years ago. And sometimes we see companies fundraising and they start too late in the process. And then they run out of time and the pressure goes up, and the VCs don't let themselves be put under pressure, and that is sometimes a little bit difficult. So if I was allowed to give you one piece of advice the whole evening, it probably would be start your fundraising round as early as you possibly can.
Typically, from when you get introduced to someone to closing a Series A, what's the time period? You're going to get to know them, you're going to get due diligence. What's sort of that timing from your perspective?
Well, to me, the more relevant criteria is how much cash runway does a company have when they should start. And in my opinion, at this point in time, have at least 9 months.
I want to add to that. Don't start fundraising the day you have the idea. You have to build a lot of infrastructure, a lot of thinking, a lot of understanding of what you're trying to do, and try to prove it out before you talk to an investor and say, hey, I got a great company, I want to talk to you. That's never going to work. So make sure you build some traction, some understanding, some product market fit analysis, some testing, something. But if you come to Jordan and you have an idea and a bunch of great slides, but there's nothing behind it, you're really wasting your time. And you're not going to get any money. Maybe you'll get some money, but not from us. So make sure you put something behind the whole thing you're working on before you start fundraising. Not disagreeing with you, but if you have an idea, don't start fundraising day 2. Start fundraising after you have materialized some context behind it. Because we see a lot of just ideas come through the pipe.
At the early stage, when you invest, you do early stage and 3 to 500,000. Are you expecting to see any KPIs, any unit economics at that stage? Or are you also looking at companies that are just beyond ideation?
We do late seed and A. We follow. We cover the last bit of the round. So I'm looking for revenue. I'm looking for significant traction. I'm looking for product in the market. To me, late seed is Ashish raised some money, used the money wisely, showed he could demonstrate it actually works. We'll be able to support him, and then we open our network to 40-some odd VCs to engage with him. But if you raise the money and you spend it and you're going down and you want to raise money to stay afloat, that's not for us.
Thank you. Ashish, what are you seeing in terms of consistent mistakes that folks are making in the fundraising process?
I think they've already covered most of it. I would only say that the people, I think majority of the time it's either running out of cash, which we already covered, or it's people-related issues that I think it's being a founder is extremely hard, and I think you have to kind of giving advice is super easy. I think the only thing I would say is just whenever you're starting a company, just try to kind of talk to founders who have tried to build a business in that category before, and talk to them and understand why did their company fail. I think they would be able to give you a lot more advice because they try to build something in the same category, and they will tell you things that will be much more relevant. One of the hacks that I found that that few folks were doing, they were actually hiring entrepreneurs who have failed to start a company or whose startups have failed, but they wanted to build a business. So they would actually bring them in. I think Stripe is a good example of that, where they were actually hiring ex-entrepreneurs who have either sold or have an exit or had a failed, and they basically bring them in and give them ownership of particular things to build as such. And that kind of like, the culture fit from that perspective is pretty good. And that sort of things kind of like, those are some of the things I would say, how you avoid mistakes, I think, more as compared to kind of like, you can't foresee what can kill a startup. Like, I mean, the whole SVB fiasco, nobody saw that coming. And, it's basically everybody was running around trying to figure out what to do. And there are all those type of things that can happen. So what you can do is just be prepared for things like this, in which one bad scenario would not wipe you out.
Can I ask Ashish a question?
Absolutely.
You had a startup or two?
Sorry?
Were you an entrepreneur?
Yes.
What was your biggest mistake?
I think I was an engineer myself, first of all. So there were 3 engineers trying to build a company and thought that technology is the way to go, and didn't understand the business side, the importance of talking to customers first. So this was the time when I was just an engineer myself. So
To that point, Jordan, you were in startups. What were the biggest
Dysfunctional
mistakes?
team. We had a dysfunctional team. We had too many alphas and not enough understanding. It was a shit show. And we raised a lot of money, but it didn't work out because we just couldn't. We weren't pulling in the right direction. So don't do that. Again, fire quickly.
Yeah, I think dysfunctional team and toxic board member can be devastating. So, for the group, what do you see as the biggest challenges facing startups in the next few years, and how are you addressing these challenges with your portfolio companies? Ekta?
Yeah, sure. So I think the biggest challenge is that if they have been able to justify good valuations in the past, there is definitely more scrutiny. There needs to be a better understanding of what went in the past, and they really need to bring, let's just say it in one sentence, they need to bring the revenue they promised to the investors on the table. And for that, they need to evaluate their team, their employees, their strengths, and to Jordan's point, if there needs to be firing and there needs to be some new blood coming into the mix to be able to, that helps them get to the revenue path faster, then so be it. And that is why when companies go through institutional investors versus corporate investors, yes, they have to, they go over this long diligence cycle from a corporation particularly. They have to understand, take cycles to understand if there's a real product market fit or not. There's one business unit saying, looks like there is a 50% product market fit, another one saying 30%, but that hard work is worth it because you do it earlier and you justify your valuation based on that, or you get a valuation you're getting in some good markets and then having to work your way towards the revenue. I think the prior is a better path.
Matthias, what do you see?
Well, again, the 2 major problems that we see right now is first, cash has become a very precious thing. That was different 2 years ago, but now it's super precious. And secondly, M&As and IPOs have declined in probabilities, in frequencies. And taking that into account, I think we like to see entrepreneurs who especially now are focusing on the client and offering a product or a service which the client is willing to pay for, in order to be able to grow revenue, ideally in a very cost-efficient way and in a very capital-efficient way. And addressing the second problem, the small number of IPOs these days and M&As, focus relatively early on unit economics with a view to an exit. I'm not saying become profitable on day one, but just think about your trajectory you want to be on in order to actually be able to make an exit happen. And if you are ever at the point where you can choose between two initiatives, initiative one is more short-term, quicker, but smaller in value, with a higher likelihood of success. And initiative two is a moonshot, but 20 years out into the future and a low probability of success, especially these days. Choose the first one. Remember, 3x in 3 years is more valuable than 25x in 10 years. And this is true absolutely from an investor's perspective. And it's even more true if you discount them for uncertainty.
Are you seeing your portfolio companies reducing burn, with no access now really to venture debt? They have to extend the run rate to the next inflection point. Is that your messaging? And for all of you, is that your messaging to your portfolio companies? Conserve cash, cut the burn.
Definitively. And venture debt, right? We had Silicon Valley Bank, and we no longer have Silicon Valley Bank the way it used to be.
One of them is here. They're still alive.
Okay, the way it used to be, which means last year we kind of lost, or the entrepreneurs lost, easy access to equity capital, and this year they lost access to venture debt.
Yeah.
So it has become a little bit tricky.
See, I'm in a different place. The money is not a problem, guys. No pun intended. There's $40-50 billion invested last year in your stage. So if you cannot get $500,000 or $1 million, something's wrong. The biggest threat for startups right now is this OpenAI stuff. If you haven't taken a look at what you're doing and took a pause and looked at where you're going versus where this thing could take you or take your industry or take your business, you really need to. It's going to rewrite so many things over the next 2 years that some companies will wake up one morning and will be obsolete. Because many of the things you are streamlining and fixing and addressing will be addressed through this OpenAI technology, and eventually it'll be like Web 2.0 to Web 3.0. So take a pause, take a look at that. That is your biggest challenge for the next 6 to 12 months. Find a way to pivot and adjust and be ready for it when it comes down, because it is coming down.
Ashish?
I think the only thing I would say is the understanding the new norm, like what is new normal in the current market, is extremely hard, because VCs themselves are kind of like struggling to kind of like figure out what should we underwrite a particular startup valuation to, and that's why there is a lack of like Series Bs and later stage funding announcements in the last year, and that's going to continue for the near future. And I think that has an impact on everything that you do, because founders needs money to kind of like grow the business, and if you don't have the money, then a lot of other things get impacted. And I think the way we have been kind of like trying to help our portfolio companies, luckily, I mean, all of our portfolio companies are well funded, and being able to kind of like plan with them on different, I would say, what are the different scenarios in which you have to be able to quickly change your path in case if something doesn't happen, and being able to nimble and flexible enough to kind of like do that is what's going to take. And I think similar to like what you mentioned, I think OpenAI stuff is also very real. Being able to understand, and I mean, I was having dinners with founders, and some of them are embracing and figuring out how it can impact their business, and some of them are saying it's not. And I think we will see where the puck goes, but it's definitely something where everybody is at least spending time on to understand how it's going to impact their industry, their function, their domain.
I know we're, very close to being out of time. We had some questions from the audience at the last event, and so I just wanted to follow up on that. Female-led startups receive a disproportionately small share of VC funding compared to male-led startups. I think the stats are in 22, female-led startups received about 2.3% of venture capital in the US, according to PitchBook, and that's up from 2.2% in 21. So women are underrepresented in leadership as well. Only 28% of startup founders are women. So the question for the panel is, what steps can VCs take to increase funding to female-led startups and promote diversity and inclusion in the tech industry? Ekta,
All right.
this is for you.
So I think there are a couple of things to consider. One of them is, in general, in the macro environment, we always talk of equality. We don't talk of equity. A male entrepreneur and a female entrepreneur, let's say you look at a fund XYZ and they'll come back and say, we evaluate both companies with the same yardstick. But, I think there is more to be put in terms of empowering a company led by a female as opposed to a male. And that's when we will have equity instead of equality. We can't keep boasting that we are offering equality in terms of evaluation. We need to make sure that we are providing the tools and the necessary ingredients of success to promote equity instead of equality, just equality.
Ashish, that's very insightful. Ashish, when we were talking earlier, I think you said that 40% of your portfolio companies are female-led.
Yes.
How did that happen?
So I think from our perspective, because we are using data and quant engine, and one of the main reasons of using data and quant engine is like, how do you remove biases? And when you're looking at data, data is unbiased, and it shows that when you're looking at data, you're able to find those high quality vetted opportunities, and that led to us having such a high ratio of women entrepreneurs.
Jordan, how about you? What do you think we can do to get to this equity?
I worked in Monticello, Kentucky, population 2,200 as an engineer. We walk in the factory, and everybody knew that if you measure something, it will get fixed. So my thoughts is there's so many factors. Put some measurements on the performance and identify how you're going to get from this point to this point to this point, and things will happen.
Anything else, Matthias?
Yeah. So I'm envious of the 40%. We at Mighty Capital have around 20% of the companies female-led, which we already think it's a success relative to the 2.3% which you mentioned, but that's good. So the good news is there is good news and there are good examples, but there are also some challenges. And one challenge is the flow of opportunities provided by female-led companies is not big enough so that everybody could get to 40 or maybe even 50%. So this flow needs to increase. In other words, there are not enough female-led prospects to invest in around, and that's a fundamental problem that needs to be addressed. And some things that might be helpful are there are networks which are focusing on female founders, which help them raise their profile in the industry and prepare them also for fundraising. There are also great accelerators who are doing exactly the same. So all female founders in the room or potential future female founders, please make use of these network and accelerators to the extent you have access to them. Maybe one thing which is really, really positive. SC Muati, who is my managing partner at Mighty Capital, we were together teaching a class at Stanford. It was at the Stanford Executive Extension School, and the topic was board governance for early stage companies. So basically teaching the role and responsibilities of board members. And we had 31 students, and the students, they were not teenagers or people in the early 10s. They were seasoned professionals. So we had 31, and we were trying to prepare them for the board memberships. Of the 31, 16 were women, and 15 were men. So there is hope.
Excellent. 10 seconds. What's the best way for the entrepreneurs in the room to reach you?
I'm good with LinkedIn, but you feel free to send me an email as well. Ekta@ufirstcapital.com. And it's just the letter U, not Y-O-U.
Okay. Jordan?
No one has my numbers.
Ashish?
You can find me on LinkedIn, my name and my fund name, Chamaeleion, or you can email me at a@chamaeleion.vc.
You can email me at Matthias@mighty.capital. Matthias is spelled with TTH. In order to help your memory, if you appreciate this, I have a few business cards here.
Excellent. Thank you so much to the panel for giving me your time. Really appreciate it. Give it up for the panel.
So yeah, the panel exceeded all expectations. That was more than brilliant, compelling, dynamic, entertaining, and scintillating. So now it's time for audience participation. So if you have a question for the audience, come on down. We'll have a line here. FYI, this is not a pitch event, so if you deliver a pitch or a thinly disguised pitch, you'll have to deal with Joe, our bouncer. So you've been forewarned. First question.
So, hi everyone. Hi all the panel members. Thank you very much, first of all, for the presentation and all of the information about the funding. So, I'm Felina Chitradewi. I'm the founder of Livert. It's the online shopping to group delivery, so people can get free and greener shipping. Just a presentation. Yeah, female founder. And by the way, my question is just about the funding. Recently, I hear this controversial information, funding slowing down, and in the same time, funding in AI, it's exploding. So does all the funding goes to AI? What should we do? Should we integrate the AI? Is it become a must-have in the company as a requirement for the VC to be funded right now? Yeah, that's my question. Thank you.
I would say it's not. I think it is. There are several sectors who are doing equally good as AI. Cybersecurity is an evergreen sector. There are new mandates coming from the government which enforce having a cyber solution for all companies. So they need to have a solution, whether they take it from entrepreneur A or entrepreneur P, doesn't matter. So I think in short, it is about finding the right product market fit. And even though when AI was at its growth phases, early growth phases, every startup got this message that you insert the word AI and you'll be heard better. Now it's generative AI, but really as soon as the evaluator, the investor peels 2 or 3 layers of the onion, they'll know quickly that that's not the case. It's really how strong your product market fit is. And data says that we are at the pre-COVID funding levels in terms of dollar amount. So it's a reduction, but it's a reduction from a spike that was just broad enough to cover the COVID period. So now whether you say that was a spike and this is a normalization, or you say that we have reduced from where we were before. I mean, you have to look at the data in a broader time spectrum, actually.
Thank you.
Hi, can you hear me? Yeah, thanks very much for sharing all your insights. So recently, Sam Altman was interviewed, head of Y Combinator, and he was talking about what was most surprising about the startups that they had invested in. And he said that they found a lot of startups that had great product market fit and that they had great technology. But the thing that he saw that caused startups to fail more often than not was that the founders just did not have the determination to be able to handle the ongoing problems and obstacles that they faced on a daily and weekly basis. Did not. And he said that that was something that it was just shocking to him because he did not see that as a qualifier to look for in people that they were investing in. So Andreessen Horowitz today has a services model where they use like founder coaches and they have people on staff like HR folks and marketing folks and whatnot. From your perspectives, the four of you, what questions do you ask to find the right qualities in the founders? And then once you have invested in them, how do you support them with the right folks so that they can actually overcome the challenges and not, give up on their entrepreneurial journey?
So I'm a little bit surprised to hear this statement. And somebody on the panel mentioned earlier something like being a founder is brutal and grueling. And I was just thinking, given that we are a Series A investor, maybe Sam Altman is correct, but those who lack the determination just don't make it to Series A. Because those which we are seeing, I believe they are very determined to make it a success.
I think the only comment I have to that is my grandfather would say, I used to go to school up the hill in 6 feet of snow both ways. What's wrong with you? Why can't you just walk to school? There's a generational change in the founders as we speak. And because we're allowing and providing a lot of support, that statement may be true. So go to school up the hill, 6 feet of snow both ways, and make it work.
Jordan, you had said that founders need to pause and take a really honest, hard look at how generative AI is going to impact their business model, their product market fit, which I 100% agree with. So my question to the entire panel is, what business models do you have a hunch are the early winners with this kind of tectonic shift?
With the what?
With this kind of tectonic shift in the underpinnings of data and the cost of generating content and customizing content? It's to the whole panel.
So to break the ice, I start. Generative AI, what it does is it rewrites stuff, right? Could be text, could be music or so, but it rewrites things. What do journalists do? There are some who do research and then they put the results into text and write about it. And there are many journalists who just rewrite what other journalists wrote. And I would say this is an area which for sure will adopt generative AI very quickly.
I'm not asking who's going to lose. I'm asking who could possibly win. I guess
I think
the
from
interest.
I think from my perspective, I think what's helpful is if you take a step back and think about the fundamental nature of like what sort of business models exist. The thing that we believe is like anything that is either creation or analysis of text, image, or video, or audio related, any sort of business models that can like depend on these things are going to fundamentally disrupt it. And you can then apply it to all sorts of industries, all sorts of things. And the innovation that's happening is happening so quickly that people who write about it on an everyday basis, they themselves are lagging behind because every major company as well as startups are just, and then the open source nature of it, there is just so much innovation that's happening in it. Like, it's just, even if you like reading about it, you will fall behind because there is so much stuff being released on a daily or a weekly basis. So the innovation is definitely happening, and I think it's an evolving landscape. So I think it comes down to how fast are you willing to unlearn what you have learned and being able to learn new things and change your foundational models of how you're going to make decisions about your business model?
I think it is not, there was a good conversation, I think, that was published where Sam Altman himself actually said that, it is not necessarily about the size of the large language models. We are all talking about the size, and he compares it to the times when we were looking at just the frequency of the chips, and which frequency, higher the frequency. It is not the race of the size of the large language models. It is really how best the AI is able to fill in the lacuna created in terms of, whether it delivers better productivity and by how much. Is it delivering higher velocity, more affordability, or is it just a better technology? So again, it comes back to whether it's a giant leap, and if it's a giant leap by 5x or 10x or what, in terms of the efficiency it is bringing to the table, or it is just a cool technology. Ultimately, whether it's a large language model, whether it's OpenAI, there needs to be a very strong adoption from the market.
To me, it's like cloud computing when it first came on, and then what's happened to cloud computing adjacencies. It's like cyber. It will be nonstop. You can get it better, and there will be something that makes you gonna get it better and better and better. It is changing the way all businesses will be conducted, and if you're on the picks and the shovels of it, you're gonna be very successful. It's not about B2C, it's about the enterprise. When the enterprises start to use this OpenAI, there's so much information security needs and demands, it's gonna change just about everything they know about running the business.
Go ahead.
Good evening. My name is Eva Galant. I'm founder and CEO of Hashiana. I have a question about the fundraising freeze that we all observe since last year, obviously. Obviously, we understand that some of you are very busy taking care of the company that you currently have in the portfolio, rescue them, and that they may struggle as well. But obviously, that's, for us as a founders, is making a little bit harder to fundraise. The question is here, how long do you think it will take before we bounce to the level before the recession? That's the first question. And second question is, Matthias mentioned previously, in terms of evaluating the company about the multiplies. We see that there is a lot of, where there's significant decrease in terms of some of the industry on the multiplies. So do you expect it will stay on this level for a little bit while, or it will bounce at some point? Maybe not to the level we had before, based on all of the growth, but to the level which will be somewhere between the current and the previous one.
So you're asking about the cycle. Where in the cycle are we in, and how long is the periodicity of the ups and downs? So cycles are here to stay, which does not mean everything will be flat. It means it will continue to go up and down and up. And it has to do with the fact that there is a time delay between our actions and the impact of these actions. For instance, in 2021, in hindsight, while it felt very good to be an investor in 21, we now know for sure the whole ecosystem has been a little bit too enthusiastic about investing. And at one point, the action was, okay, that's crazy. Stock market dropped, and the valuations in our industry dropped as well. And now the question is, what happens to the results of the VCs? It's too early to tell, because it takes quarters, probably years, for this to flow through. And as long as we have this uncertainty, it's probably not yet the time to correct for it and say, okay, the valuations go up again. So my prediction is, for sure, at one point, the valuations will become a little bit higher than they are right now. At one point, they will probably become even lower than what they are right now. And it's a cycle. It will be up and down, and for me, it's impossible to predict. How long are we staying if we are now in a down cycle? How long are we staying right now? Let me say, if I compare insurance to VC investing, there are many similarities, but there is one big difference. In insurance, by the way, we have the cycles as well. If there is a hard market, that's when all premium levels are very high. At one point, the first underwriter thinks, okay, now the price levels are so high, that's an opportunity to chase the ambulance and start writing business. And that's the beginning of the break of the hard market. The difference to VC investing is our model here is built on syndication. His VC is not the only VC who invests in a specific company. So whenever he invests, he assesses the quality of the people, and everything what we discussed comes to a conclusion. It's a great company. It's a great company, great founders. But then the next question is, will this company be invested again by somebody else? And right now, it's hard to tell. All we know is not all the companies will be invested again. And then Jordan becomes a little bit more cautious than he otherwise would be due to the syndication. And that could mean maybe it takes a little bit longer than we wish it would be where we are right now. But that's a speculation.
Do you think 23 is the year we'll find the bottom?
Huh?
Do you think 23 is the year we'll find the bottom?
Yes.
Yes. Yeah, the bloodbath isn't over there. 2021, there was money falling from the sky. You know, the government was putting $2,000 billion in the economy. Money was for free, and it was the health tech and all that stuff. And it was money just falling from the sky, literally. Crazy valuations. If you look at 2021 performance, and you just erase it, and look at 2020 and 22, 22 is still on trajectory to the historical performance from 2012. It's just going slowly up and up and up. Then 21 comes in, big spike, then comes back to correct. So I'm glad we're correcting. 21 was crazy, insane valuations, out of the world craziness. Now we're back to somewhat normal, and it's going to slide down a bit. I think by the end of this year, we'll be normal. If you're raising, forget about 21. Just forget it existed. You're not going to match those valuation numbers in your craziest dreams. Think of a valuation number that will get you what you want to get, the value you need. Go do business. Forget about fundraising. Put the right number of valuation, get the money, and go. You're not going to beat the 21 numbers ever.
Great. Next question.
Hi, my name is Bharat. So I heard a couple of you, especially Ashish and Matthias, mention about concern about cash burn, and then basically like thinking about cash as king.
Can you be a little closer to the mic?
Yeah. Can you hear me better now? It's very well known that typically until Series B, a lot of startups don't have a CFO or a finance leader. So as VC investors concerned about cash burn, what tools do you employ to get visibility into the cash burn of your portfolio companies? And the second part of that is that once you identify companies with cash burn issues, what do you do to influence the founders to course correct?
Companies with cash flow issues?
Cash burn issues. They're burning more cash than they should be and it affects the runway?
Don't invest in them.
If you've invested in them already.
Ekta?
I think two things, right? First of all, I think you need to understand, I think it's a very simple thing to understand how much are you spending each month and how much money you have in the bank, and based on that, how much runway you have, right? Beyond that, anything more complicated, there are outsourced CFO services that are available that you can talk to, and they have, depending on who you're speaking to, they generally are customizing their plans to work with startups, and they will work with you. So companies at early stage generally would have working with these outsourcing CFO, and then as they get to more crunch conditions, and then I think we step in terms of helping them understand, because I mean your investors would help you because there is an aligned interest to making sure that you're successful. So from that perspective, I think you should if you have investors, you should ask them. And one of the other things that happens is we don't know, because you are the one who are running the ship. So you should raise your hand and say hey, I need help in figuring out A, B, or C, and then your investors should typically step in, or at least they will point you to resources, because they have already given you money and they want to make sure that they are able to get it back and much more if they can.
But Ashish, what sort of company is suffering from cash burn and they don't know how to solve it? Where's the hope for these people?
I think if you kind of invest in many folks who have never dealt with finance before, it's something they might not have heard of, right? I mean, so I think as you said, a lot of these people have raised capital in the last 2-3 years, and their valuations are far, far away from their revenue multiples. So from that perspective, I think having somebody who is more financially inclined is helpful to at least help them understand how to think about those multiples going forward, because that's the reality of today's market.
I don't think cash burn is a problem that can be solved just by having a good finance expert on the team. I don't think it's a CFO problem, if at all, if it is maybe a 20% CFO problem. There is a lot of creative thinking and strategic thinking that goes into how will you conserve cash. Do you have the right partners to go to market, or you're using your marketing team a lot for something that you could gain by having a smart partner, and which can be an entity, or it could be a smart advisor on the team as well. Which avenues do you have to go into to gain those efficiencies is more of a strategic thinking that cannot necessarily be achieved by having a CFO on board. Depends on the expertise of the CFO, of course, but I mean, it is not, hey, because I don't have this function on my team, I might be burning more cash. No, I think there's a lot of opportunity for creative evaluation of where things can work better in terms of efficiencies.
I would definitely echo that. I see with my clients, teams really hunkering down, coming up with creative solutions. It's not some expert, some CFO, or any McKinsey person. It's the team that knows the business and knows what the levers are to push and pull.
I have a different point of view on that. I think I agree with you directionally, that the CEO and the team should figure that out. But I think at the same time, you'll be, I think, just understanding what are the different levers for you to kind of understand your business and pricing. I think pricing is an area which is very startups, as they say, should always charge more than what you're normally charging, and many other similar things. But I think I agree with you directionally, it's a combination of these things. As you said, it's very difficult to give a generic advice for a wide variety of problems that can be applied. So depending on the industry, the function, the domain, and the space where you are in, either of those things can become valuable to you.
Thank you. Next question.
Good job.
Hi, I'm Sherwin Farhang. I'm building a cybersecurity company, so I appreciate the shout outs in security and cybersecurity. My question's pretty simple. I guess I'd like to see each of your answers. What is the best way to raise pre-seed?
I think your sector is interesting from that perspective. It has a sector-specific answer, I guess. And there is a lot of feedback that needs to go into a cybersecurity company in the early stages of the company. Am I going to go to market independently, or am I going to partner with somebody? am I going to be part of a vertical stack which sells to all the major corporations in the world? In which case, I need to understand that whether I'll be able to win that vertical stack integrator as my partner or not. Does my team have the ingredients to win that vertical stack provider as a partner? And so those are some of the considerations I would have to look at pre-seed companies, particularly in cybersecurity, in the cybersecurity space. And RSA is coming up. So it's a big party there.
See you there.
I think every cybersecurity company that I have heard of or known is going to be there, and there's a lot of activity happening next week at RSA.
The real answer. So it's very hard to raise a pre-seed because cybersecurity is such a crowded space. There are like 3,000 plus companies going to be wandering the streets of San Francisco, and then you can point your finger and figure out. I think what I've seen so far is like people who are trying to raise capital today comes down to the team and then their domain expertise. Because what people are going to look at is like, what are you trying to solve, and do you understand the domain and who you're going against, and why would someone buy your solution versus 5,000 other solutions that exist in the market?
I do want to add that to that feedback that there is still hope. There is a lot of compliance requirements that have fallen on the companies. There's a lot of privacy requirements that have fallen on the companies, and they're brand new. And depending on which geography you're talking about, I can tell you Japanese market has the new AAPI regulation that came into effect and has been amended in April of last year. And since then, a huge number of Japanese corporations are looking for a holistic solution in the privacy protection space. So it is not a generic answer, and it's not like, it's difficult. Yeah, it is difficult if you don't understand how you're going to go to market, but if you have a solid plan and you have the right team, why not?
Yeah, I will just say, I see my clients that are getting, pre-seed funding. They've really validated the hypothesis. They've demonstrated some level of market fit, and typically, they have some unit economics, even though it may not be, significant. But they've got something to show the early stage investors that there's some there, and I've seen actually an uptick in pre-seed funding for clients because they're making that determination to get further than they would otherwise have been maybe 2 years ago.
Sure, thank you. So I have a question about Shark Tank. And so before our product was stable and ready for the market, we were invited, but the reason we decided not to go there because we have seen some companies fail because they went too early to Shark Tank and got like too many competitors come up because they shared it on TV. So my question is, how much value going to Shark Tank adds? And also my other question is, how much value getting mentored by NASDAQ or getting featured on Times Square ads, because we had both, we were mentored by NASDAQ and got featured on Times Square as well. How much value does it add to a startup? Or winning awards, how much value does it add to a startup, or doesn't add any when you go for investment?
You should tell us, because you've been through all three, so how did that work out for you?
So far, we decided to bootstrap till we were ready to go to market. So right now, we have 2 customers, talking to a few more. And also right now, we do have some interest from investors, but they don't know that we didn't go to Shark Tank, or they don't know yet that maybe 1 or 2 of them do know that we got mentored by NASDAQ because we have been talking to them, but others don't know yet. So I don't know answer to that.
It's just short. It's just a PR thing. It does not make a good company or a bad company. If you get PR, you got it. It does not make you investable or not investable.
So it doesn't make any difference.
It's a PR thing.
Mm-hmm. Anyone else? Thank you.
What I always try and tell my entrepreneurs is to switch your hat and think like an investor. So an investor is going to have 50 deals on the table that week.
Yeah.
What is going to make your company stand out from all the others? and when I do angel investing, I look to see where the risks are being mitigated, whether it's execution, or technology, or sustainability. And so if you've got great PR, that may be great. You don't have something that's really going to make you stand out from your startup and make the risk profile better than all the others on the desk. It'll be hard to get funding no matter what kind of PR you've got.
I think relevant PR is very. I think I've seen, at least personally, few companies do it really well. Being able to do it at the right time and being able to kind of like use that in a strategic way, I think is very important skill, which is very hard because it comes down to storytelling, right? Because you're trying to get attention of the right channel. Like, for example, if you get covered in TechCrunch or something like that, it would create a lot of buzz for you. And everybody's going to read about you, right? So it will help you hire better. It might get you more investors to come in to kind of like talk to you at least, and create a lot more buzz around getting some more users to come in. So that's why I think it depends on like the type of readership you're going after and the medium that you're choosing. And I think based on that, it would actually help you decide, like from that perspective, versus Shark Tank versus getting featured on NASDAQ versus writing an article in TechCrunch or something else. So I think I always suggest, like, it's not, you have to be strategic in terms of understanding who the readership is, and then how is that going to impact your goals of what you want to achieve.
Thank you.
Maybe one observation. If you ask the sharks individually, who is the best looking shark, Kevin would for sure say that he is the best looking shark. We heard this exactly the same statement from him. So in this sense, I would like to officially make you to Mr. Wonderful of this panel here.
All right, on that note, let's give it up for our panel. Awesome. Let's give it up for Roger, our awesome moderator. Let's give it up for Procopio and all our sponsors. Let's give it up for our event team and our video team. Let's give it up for Joe, our bouncer. Let's give it up for the audience.
Let's give it up to Rob for putting on an amazing event tonight.
So stick around, network, socialize, and connect. You'll have a chance to talk to the panelists one-on-one. There will be an after party, and we'll settle that now. So 3 choices once again. The Rosewood. Again, it's Tuesday night. Who's for the Rosewood? Okay. The Patio. Pizza My Heart. All right, it's been decided. And the winner is Pizza My Heart. So I'll see you guys there. Thanks for coming. See you next time.